Good morning, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the Friday morning call. So we've obviously had a very interesting week this week in the markets. We've had, now after yesterday, 2 outside bearish reversals, but as we've seen a lot over the course of the past year, year and a half, and even more than that, the market has been able to shrug off some bearish signals, but as we talked about even earlier this week when I was on the morning call with Scott on Wednesday, there are a lot of signs under the hood that things are weakening a little bit. You're seeing some leadership breakdown, stuff like that. Yesterday, obviously, you had the news with the Russia-Ukraine tension sort of ramping up again a little bit, triggered another loud outside day. This morning, futures are slightly negative. They were positive earlier. They've weakened, but they've actually bounced off their lows in the morning, which I'll take a look at in a second. But everything's focused on the headlines right now in Russia, Ukraine. And then you add in the fact that China economic data has been extremely weak. A lot of people accuse China of fudging their economic data and making it look more favorable than it actually is. Doesn't seem to be the case right now because the data that's been coming out of China has been very weak, triggered sharp sell-offs in Chinese markets, some strength in the yen. So a lot of different developments right now sort of combining to weigh on world markets. But so far, U.S. markets are holding up reasonably well. Yes, we did get some sharp selling yesterday, and I'm not sure there's going to be a lot of people looking to hold longs into the weekend, but we'll see how that develops today. But you take a look at the chart of the spiders. As you can see, on Wednesday, we had this, or on Tuesday, excuse me, if you go to the charts, we had this big outside reversal where we engulfed the previous day's candlestick. And then we got a gap down the next day, but then we were able to rally back into the flat line. So it was sort of maybe traders got in the mindset of here we go again. The market's showing resilience, shrugging off some weak signals. But we did get a gap up yesterday, but then it led to almost immediate selling off the open. That accelerated to the downside once those headlines about Russia doing military exercises on the border of Ukraine, Russia blacking out any non-propaganda news sites, even detaining some U.S. journalists, questioning them. Militia groups were doing that in the Crimea region, and then obviously you have the referendum vote that's going to be big, and then see how that develops from there because both sides are talking tough right now. Russia, Ukraine, it seems like it's near a boiling point. So, like I said, this weekend, a lot of people may not be looking to take many longs into this weekend. But also, if you're short, there's a possibility that nothing happens and you get caught in a big gap up. So I think it's going to be a risk-off type day in both directions. But we'll take a look at the 5 minutes to see where the futures are. A live look. We went all the way down here to a low this morning of 184.45. When we put together the morning note, futures were up here. They were around the flat line, slightly positive. But we went below yesterday's low in the pre-market. We have bounced over the last few minutes, last half hour, 40 minutes or so. So we're up here back around 185 on the spiders. If you take a look at that on the chart, we're slightly negative now. So any selling that's going to happen, it looks like it's going to happen now during the session, which I think people would prefer. And I think active traders in particular right now are going to maybe take a day trading approach today if they even trade. Cash is a position. It's okay to sit a day out, especially a Friday. With weekly options expirations and the choppiness that we've seen on a lot of Fridays, I would definitely say this is not a Friday that you necessarily want to press things in either direction. If you are going to take positions into the weekend, I think you need to have a little bit of balance. But I'll go over a few charts that I've found interesting that sort of tell the story of what's been going on in the market. Let's take a look at a couple world indices. If you take a look at China, obviously, emerging markets lagged last year in a big way. China was a part of that group, and then it's been very weak this year so far. And yesterday, broke below this key support level from February as the damage just keeps coming. China finished down around 1% overnight session, and then Japan, EWJ, even weaker, finished down around 3.3% overnight. So you're seeing that really weaken after it was one of the sources of strength in world markets over the last year plus. As you can see, really strong run in 2013, some extreme volatility there as well, but it looks like it could be breaking some upper level supports here, and then 200-week moving average you see down there on the daily chart is already broken below its 200-day. So definitely some developments that aren't exactly the most encouraging thing right now when you talk about world markets. And then you talk about a flight to safety yesterday with all the news coming out. Copper was sort of foreshadowed some of the weakness that we're seeing in economic data and some of the weakness that we're seeing in the market. Copper is often considered a leading indicator. There's a lot of lagging indicators. People talk about jobs reports, economic data itself is lagging. It's not going to forecast anything that's going on. It's going to tell you what happened in the past. So not necessarily a great way to make trading decisions based on reactions to something like a jobs report. But copper is considered oftentimes a leading indicator. and you got this big gap down here on the 7th, which was last Friday, and then you've seen it just continue to plummet, and it's caused a lot of people a lot of anxiety about what this means. And you go back, you look at the monthly chart like we looked at on Wednesday, this is breaking, you could call it a head and shoulders pattern if you're a pure technician, breaking below key macro support levels back to levels that we haven't seen since 2009. Obviously, the stock market's been very strong since 2009 as the Federal Reserve's come in, done aggressive QE and stuff like that. But in terms of the economic recovery, it's still been relatively slow, relatively tepid, and you're seeing copper all the way back down there. That's definitely not a positive development when it comes to a leading indicator for the economy. And yesterday, you also saw a flight to safety, a flight to lower risk assets, and you're seeing bonds. This is a lesson in sort of market sentiment, is that everyone was thinking at the end of last year, oh, we're tapering QE, the new regime going to come in, do a regular schedule of tapering, bonds are going to fade, yields are going to go higher, but you had so many people reaching that obvious conclusion that you actually had the reverse, and you had so many people on one side of the trade that there was really only one way for it to go, and that's what we've seen this year. Bonds have had a resurgence. As we've had some headlines, and people have looked to get back into some lower risk assets after the big run in stocks. And then yesterday, obviously, huge bar on that Russia-Ukraine news, on the weakening economic data in China. People looking to long-term U.S. Treasury bonds. So something interesting to take note of there. It closed back above its 200-day moving average. So if we can continue higher in bonds, maybe I'll look at the pre-market, see if we get some prints on that. 108.90 is where we are this morning. So we are higher in bonds so far this morning. They're continuing to get a bid as anxiety continues over that situation in Ukraine. And if we can get above this 200-day, form a base above that 200-day, it could even push us higher because we're breaking above some key resistance levels, just like you see copper breaking, or something like that, breaking below key support levels. You're also seeing this break higher out of a lower level pattern. So like I said, if we get above that 200-day moving average and build a base above there, you could see, I think, bonds continue higher, especially if this situation boils over into a war in Ukraine. We're not political analysts, but it's definitely something you have to be aware of. And then gold is another signal that people are looking for a little bit of insurance, a little bit of hedging, some protection against things that could evolve in this geopolitical climate and overall in the world economy. With things slowing down, you've seen a really strong uptrend in 2014, sort of a similar situation regarding sentiment. Everybody was on one side of this trade. Everybody was hating gold, and then because of that, you only had one way for gold to really go, and it's trended higher really nicely. There's been a few pieces of news, like when the Russia-Ukraine situation seemed to get dissolved a little bit earlier, you didn't see gold sink like you might have thought it would. When you saw some really stronger economic data from the jobs report in the United States, you might have thought, okay, that'll definitely potentially increase the tapering schedule and could lead to weakness in gold because QE is a big catalyst for gold. But it actually held higher, and then you've seen it gap up as those tensions have increased. So really constructive there for gold. In the same way you're looking to see if bonds can hold above the 200-day, you're seeing gold really hold above the 200-day really nicely and maybe set the stage for a bigger move higher. And you look at the weekly chart, breaking above a key pivot here this week. And so the next challenge for gold will be up here in the 137.55 area. So if we can get above there, you have some gaps that we're talking about here around 150 on the GLD. So be very interesting to monitor whether gold can continue to base and potentially set up for another move higher. And as far as stocks go back to the daily chart. As far as stocks go, we're seeing some interesting rotation going on right now. And you're seeing, like we talked about on Wednesday, some more weakness under the hood that you're not really getting represented within the indices quite so much. And you're seeing something like the biotechs, for example, weaken. Biotechs, on one hand, you might say you look to buy the dip on a really strong sector. When you get really big acceleration like we saw yesterday below the 8 and 21 day, if it doesn't reclaim those moving averages in the next couple sessions, you could think that it could continue lower. You look at the NASDAQ. NASDAQ, obviously a big engulfing bar, looks similar to the S&P, but you're seeing some high beta tech stocks. Obviously, it lost its 21 day there. Google's been an absolute rock for the market. It's been very seldom that it's broken the 21 day. You saw it for 2 days here, and it quickly snapped back above. And you're seeing it close below yesterday and not really bouncing today. So you got to see if something like Google, which has been just an unflappable leader for the market, see if that weakens. Look at something like Apple. This is sort of separate from a lot of other things, sort of trading on its own, but having trouble breaking above this downtrend that we've been highlighting here. If you're trading Apple, that's the level to watch. I wouldn't get too much interest in it unless it breaks above there. A lower level pattern that actually looks a little bit better than some of the others is Amazon. And let me take a look at the 5 minutes, see where Amazon is this morning. Amazon is about 374 this morning, so it is up. And this is an example of a stock that it was Mark's trade idea of the week 2 weeks ago. Looked like it wanted to go yesterday. They raised the price on Amazon Prime. People think that could help them monetize a little bit better, improve their earnings. But it was really strong early on, then reversed because of the market weakness. But this looked like one that wanted to go higher, but just couldn't because of the broader market weakness. And it's up this morning, so that tells you that just because it's getting relief from pressure from the broader market, it could definitely want to go higher today, and it's definitely one that I would keep on the radar if you're looking for longs. But last night off the charts, we highlighted 5 new short setups also that I think right now, if you're going to go with positions into the weekend and even going forward with all these geopolitical issues and some of the technical weakness that we're seeing add up, I think it's good to have a little bit of a balanced book. And I'll share a couple of those with you. You got to be a subscriber to get all of them. But CVX, Chevron, one that definitely looks like a bull flag to me. You can draw this down move here from late 2013 into the beginning of 2014, and you haven't really seen a ferocious bounce here in Chevron, and you're almost seeing a little bit of an H pattern. As you could maybe call it a bull flag or a bear flag, but you could also see this flag is rounding off a little bit and forming a sideways channel, whereas it was an ascending channel before. So you have a really clear area to potentially enter here. As you see below, you could just use yesterday's low, for example. Take a look in the pre-market to see if we have any significant printing, not in particular. But you just use yesterday's low as your area to potentially look short on Chevron. And then I talked about the biotech names. The Chevron's more of a laggard name, which most of the ideas that we included as shorts last night off the charts are laggard type names. But Gilead is one that we previously had as a long on off the charts. But as you can see, some really aggressive selling in Gilead. Hasn't been able to reclaim any of that. And then yesterday, big down bar to break below this pivot low here that was 77.81. So yeah, it is a little extended to the downside after yesterday's move, but it is just breaking above this breaking below this upper level flag and could continue lower. First stop, you'd have to check on its temperature, would be around 76. And beyond that, you could see it get down here in the $72, $73 area. But a couple other things that I just caught my eye this morning. You're looking at CCJ, Cameco, which is one of the uranium stocks. Really strong yesterday. Now, this is one that had as a really nice bull flag looking pattern. I talked about it maybe a month or so ago. I'll go out to a longer time frame. I'll even go out to a monthly to take a look at it. As you can see, it's been in a really tight lower level base here since early 2011. It was really strong, had some weakness on the whole Fukushima reactor situation in Japan. But looks like people have had some time to get over that a little bit, as bad as that may sound. But it's breaking out of this lower level pattern, and it looks like bull flag after a really nice igniting bar here back on February 25th. And people think that the situation in Russia and Ukraine could ignite something like an alternative energy source like nuclear. So something to keep an eye on here with CCJ. I'll take a look at the 5 minute. No real printing so far this morning, at least on this chart. So 24.98, yesterday's close. It came back right into that breakout level, so see if it can get some upside attention today, sort of like Amazon. It got weighed on by broad market weakness, see if it can continue higher. And just a few things. Yesterday, my first inclination when things started weakening was, all right, look at what stocks have exposure to Europe, and those are the ones that you want to be looking to short, especially Western Europe, German stocks that are listed on U.S. exchanges, obviously Russian exposed stocks and Ukrainian exposed stocks. One of the first ones that comes to mind would be Yandex, but Yandex already getting hit really hard, so a little bit hard to short something like this that's so weak. If it were to base a little bit or bounce a little bit to work off some of this oversold condition, maybe you look to short it. But you look back on a longer time frame, obviously that's a really harsh down move over the last 3 months that you've seen. It's hard to short a down move like that. Sentiment definitely already negative there. Look at something like Siemens, another one that I looked at to potentially short, but obviously yesterday's huge down bar sort of coming on the heels of a really big down move that we've seen over the last week in Siemens. A little bit hard to short that, but if you do get some sideways action, it's definitely one that I would look to short. And SAP, similar to Siemens, a big igniting bar down yesterday. We couldn't list this one. It's not as calculated as a setup on off the charts, but it is breaking a key support level here, so something to keep an eye on. And then Deutsche Bank. The financials overall are a sector that there's some weakness that definitely shows up in some of the relative weak banks that we're seeing in the market right now. But if you look at Deutsche Bank, obviously a German bank, take a look at the weekly chart, breaking this ascending channel that's been in place since early 2013. this week. So definitely something to take notice of there. I would not be surprised to see this head lower, but like I said, with Siemens, with SAP, with the Yandex, hard to list these as swing short setups given the breakdown that we've seen already this week. So, hey, we'd love to get a retest maybe of this flag to short it, but if that were to happen, I think that would mean that this brouhaha in Russia and Ukraine didn't actually come to fruition, and in that case, the thesis would be a little bit more broken. But in terms of U.S. banks that look weakest to me, Citigroup came into this year looking like one of the better banks. It had a strong earnings report, the most recent quarter heading into 2014, but after the first earnings report of this year, things definitely changed in a big way with Citigroup, and it's become one of the laggards of the sector. Broke below its 200-day, tried to get back above it, but like we talk about, couldn't hold above it for more than 2 sessions, and each time it got above, it sold off a little bit. And then now looks like it's breaking a slight little ascending channel type base, sort of like Deutsche Bank, but not as strong. And Citigroup does have significant exposure to Europe. So if you're looking for that type of thesis on your ideas, Citigroup is one to keep an eye on. Still has some room down to this pivot low, and I definitely think you could see this whenever you do a pairs trade, for example, with something like Bank of America. Citigroup's breaking down. Could break below this pivot low, 46.19. The pairs trade long would be with Bank of America. You're seeing Bank of America hold up extremely well. Ignited a little descending channel here back into only its 8-day moving average, and yesterday it was a lot stronger than a lot of other stocks, even though it did have a big travel range. But maybe a pairs trade there. Citigroup short, Bank of America long. Just some divergences that we're seeing within the banks. But overall, that's your morning call for today. Obviously, geopolitical issues. We talk about trying to ignore those, over a swing basis. But when you talk about being an active trader, the risk reward of taking longs or shorts into the weekend just doesn't seem to be there. It seems like a coin flip. It seems like you're playing the guessing game and looking to get lucky. I think you're going to see a lot of people not excited, definitely about taking longs into the weekend. So it'll be interesting to see how strong the selling is today. Yesterday, obviously, we came a long way. We opened higher and had that big harsh reversal. So I think you'll see a lot of people just sit on the sidelines, and I think it'll be a quiet day. Like I talked about before on these Friday morning calls, sometimes on Fridays, because I do a lot of Friday videos, I come in here and tell you that same thing. Be cautious, be aware of choppy action. Don't be afraid to sit on the sidelines, but a lot of times that's the best advice you can get. And any professional trader you talk to, one of their keys to success is not losing money on days when they don't feel like they have an edge. And that, I feel like, is going to be one of those days today. But if you do insist on taking some positions, I think you have a few longs, have a few shorts, be balanced, and take that type of approach. This has been John Darsie here for your morning call. I will be back here for the daily recap, I think. Maybe I'll try to get Mark on here with me or something to add a little bit more. But we'll see you back here for the daily recap.